the disclosure requirements that were released by the SEC, California, and the EU all have different requirements. And if a company has to report under more than one of these frameworks, that will require substantial resources and open up the door for potential litigation.
Joining me today to talk a little bit about the insurance landscape is Steve Kelly, Director with Alliant Insurance Services, and Christian Hartman, AVP at Arch. Christian, let's start with you. Could you provide an update on the securities class action landscape and trends in the REIT space? And separately, as it pertains to non-SCA litigation, how is Arch evaluating emerging trends such as sustainability?
Sure. So starting out with securities class actions, core securities class actions, so non-mergers and acquisitions focused on accounting or disclosure-related lawsuits, following a flattish period from 2019 to 22. 2023 saw a 26% year-over-year uptick in filings, and it's up 9% versus the historical average. This is increasing despite the decline in IPOs, SPACs, and crypto filings, which suggests that there's more lawsuits being brought against traditional public companies. Dismissal rates are holding steady at around 50%, which is encouraging, but from a primary perspective, even a claim that gets dismissed can still lead to a loss based on elevated defense cost trends. For REITs specifically, we generally see between 1 and 5 core securities class actions in any given year, really just as a function of smaller sample size. In 2023, we saw 3 SCAs, all of which were core. And really in the REIT space, we haven't seen very many settlements in recent years, but the few we have seen are in line with non-REIT companies, which suggests that severity is in line. From a non-SCA perspective, we're really focused on ESG, which has gotten increased focus from regulators and investors alike. The disclosure requirements that were released by the SEC, California, and the EU all have different requirements. And if a company has to report under more than one of these frameworks, that will require substantial resources and open up the door for potential litigation. We're really honing in on how companies are managing their strategies and goals as they've been reporting under sustainability frameworks for quite some time. But standardization brings more risk. It brings a little more accountability and transparency to regulators and investors. And we think the plaintiffs' bar will keep a close watch on this. We're engaging with our insureds on their ESG exposures and how that could enhance their D&O risk potentially.
And Christian, can you give us an update on the overall D&O market and specifically as it relates to the REIT space?
Sure. So the overall D&O market went through a hard market cycle from 2019 to 22 after years of elevated and record securities class action activity, loss cost inflation, and low interest rates, and then the fear of heightening claims during the pandemic. We saw a gradual softening of the market throughout 2022 and 2023 as new capital flooded into the space, and there was less IPO activity, which were contributing factors to bringing down premiums. Same held true for the REIT space as well. The REIT space did go through its own respective hard cycle, but we view that as more of a function of getting pricing in terms at what we view as sustainable levels to really have a long-term program to withstand all parts of a real estate and insurance cycle. Thus far in 2024, we're seeing a stabilization of pricing, which we view as healthy for the industry, and we expect that trend will continue for the balance of the year. But in some cases, we're seeing pricing get back to sort of pre-2019 and 2020 levels, which the whole industry had some unprofitable years, and we don't think that is a sustainable long-term approach. But Arch's view of the REIT space is not changed. We're very committed to the REIT sector, which is reflective of our view of the overall risk quality. We are closely analyzing each risk every year on a case-by-case basis, evaluating asset-specific trends, macro trends, market volatility, and we make adjustments with how our insureds are performing and with the market. And the approach is the preference is to not take a punitive reaction in any given year. But we have a dedicated team. We've deployed our capital by an additional 50% from 2019 to 22, and that continued last year, which just demonstrates our commitment to the space and our view of the risk profiles.
Now, Steve, can you please explain how the Nareit program helps to distinguish REITs from other publicly traded companies?
In comparison to when we see submissions and underwriters evaluating non-REIT public companies, we at Alliant work with Arch and the Nareit membership, as Christian was just saying, to produce a risk profile that is best in class in the marketplace. So we utilize, certain risk factors like their unique corporate structure, their overall operations, their, state incorporation status, to really format a better outcome for the REIT than we see in the general marketplace.